Alrighty, folks, if you tune into the daily financial news, you know that one of my big fears is rest of world is changing how they invest. And what does that mean for the US? It really means that we are going to see less investment in the United States and more investment rest of world. I want to talk to Mr. Dan Bird about what and how we might see this. Will we see this in the stock market? Will we see it in gold? Will we see it in Bitcoin? Will we see it in treasury yields? All of these things are at play. Plus, we have the big, beautiful bill, which is estimated to add $3.5 trillion and frankly, might piss off the bond vigilantes. We got a lot of stuff to talk about today. We are recording this on Memorial Day. Never forget that over 1 million people have given all to protect this amazing country. So let's not forget what Memorial Day is all about. Mr. Bird, where do you want to start?
Well, that's a good place to start, Memorial Day, because yes, it is important to recognize and remember everyone who gave their lives to protect this country. And all of my cartoons for this week's newsletter were related to that as well.
Like maybe we'll take a quick gander at that. But this is a real concern. I don't think many people realize. Maybe I mean, Ray Dalio is certainly talking about this a lot. But when you go from a worldwide economy that is predominantly U.S. asset based to one that is just going to be less U.S. asset based, that's going to have massive ramifications, Dan. And I'm not sure where to look. Is it the stock market? Is it yields? Is it gold? Is it Bitcoin? I just don't know
Is
where
it,
to look.
is
It's
it
so
all of the
many.
above?
It probably is at some level for sure. But why don't we break it down and talk about what
So
you're
I
looking at?
don't I don't know if you remember one of our conversations. It probably goes back a couple of years now
Mhm.
when I talked about what we were talking about the reserve US dollar as a
Yep,
reserve currency.
for sure.
And I talked about what potentially could happen if not so much that a second reserve currency or another reserve currency comes about, but just if the rest of the world stops buying our bonds,
Yeah,
not even selling our bonds, just stops buying our bonds.
yeah.
And what would happen is the rates would go up. So you know, if you're not buying bonds, then the rates go up, the yields go up.
Mhm.
That will make our debt much more expensive to refinance. We have 1/3 of our debt that we have to refinance in the next 12 months,
Yeah,
right? So if rates do go up, I mean this could be the nuclear option for China,
could
where
be.
they say they're already um, they are no longer the second biggest bond holder. By the way, did you know
No,
that?
that I did, yeah. And I just read this morning they actually sold 18 billion treasury bonds in the last couple of weeks, forcing the treasury to become a buyer. I reported this morning
Right.
in the last 2 weeks, the treasury, I want to get the number right, bought 78 billion. Some people are calling this QE again,
Yeah.
which that was interesting. So this
Yeah,
is
it kind
all
of is. I
happening
mean,
right now.
the Fed's the biggest holder of bonds.
Okay.
Clearly, number two is Japan. They have been for quite a while, a really long time actually. Number two has been China for the last 5 or 6 years, but just in the last week or so, the UK has overtaken China. It's now the second biggest bondholder.
That's interesting. So again, I really do think we need to watch yields, and it's not only U.S. yields. I don't know if you saw what happened in the Japanese bond market, but their 30-year bond exploded off the bottom
Yeah.
here in the last 2 or 3 weeks.
Yep. And I think that will have an effect eventually.
I think
And I
I
don't
think
think,
it's having an effect right now. I mean, if you're a Japanese investor who used to borrow in yen and invest in dollars, that yen carry trade could unwind in a hurry. I mean,
yeah,
why buy U.S. Treasuries at 4 when you can buy Japanese yen at 3 or Japanese bond at 3? That's what Japanese investors are going to think. They're going to repatriate
right.
yen back to Japan. It's happening right now. The question is how much and how quickly does it scale?
Yep, that's right. So if in order for the rest of the world to continue to buy bonds, they have to have confidence in the U.S. economy, and
Hmm.
which translates to our debt.
Yep.
And our debt continues to explode. And the big beautiful bill that you mentioned will just add more to it, but it hopefully will also create opportunities for growth, and growth is the way that you reduce the deficit and tariffs, frankly. So the tariffs, interestingly, might actually reduce the deficit. It won't necessarily reduce the debt, but may reduce the deficit.
Mm-hmm. Good.
So we'll see how all of that plays out. I think we're going to know in the next 6 months how it's going to play out.
Now, so just to be clear, when you say how it plays out, when you're what is that in reference to? How much tariffs we collect? Is that in
Well,
reference?
no, it's in reference to everything. It's what kind of effect is it going to have? Is it going to crash the stock market? Is it going
Okay,
to
got it. So
destroy the
okay,
bond market?
so we have a timing. So I totally agree with you. This is coming, and we'll know in 6 months. You and I
Right.
agree on that. But what I'm struggling with is because this hasn't happened before, at least in my adult life. What are some of the things that we could look at for either liquidity being drained or buyers disappearing? I mean, there's so many things that could be that straw that breaks the camel's back. I mean, what are some things we can look at?
Well, when you talk about liquidity, global liquidity, there's lots of different levers included in that, right? And two of the biggest ones are oil.
Okay.
So when oil comes down, that most countries need oil for their economies. If oil gets cheaper, then they have more money.
Okay.
So that improves liquidity.
Okay. Watch oil.
And the second one is the dollar, the US dollar. So because it's the reserve currency, other countries are primarily denominated in dollars.
Mm-hmm.
So if they want to refinance their debt and they can do it with cheaper dollars, then that creates more liquidity.
Yeah, so
So
I've actually heard that the U.S. dollar's down. I haven't checked to verify this, but it's down over 10% this year. And some people are calling for the U.S. dollar to appreciate another 10%. I heard that or read that in reference to publicly traded companies actually being a tailwind. But if you
mhm.
play it out at the country level, that's another interesting way to look at it.
Yeah, for multinational companies, it helps them because it makes their products cheaper overseas.
Yep, exactly.
So it will help multinational companies, which is really the large cap companies. S&P 500, think of that. S&P 100. It will do the opposite for small cap companies. So think of the Russell 2000 because they're not typically not doing business overseas. The
Right.
small caps. So they've got more expensive dollars.
Mm-hmm.
Um, we'll look at the dollar here in a minute. It has definitely come down 10%. That's about right. Could it come down another 10%? It could. Yep. But if it does, that means more liquidity.
Yeah, but this is where it puzzles me, right? Because we're going to see the dollar come down, and if this plays out the way I think it is, we're going to see rates go up, which is just ass backwards from my 30 years of economic in studying the system. When rates go up, the dollar's supposed to get stronger. It's not supposed to get weaker, and that's what makes this time so bizarre.
Yeah, it depends on the reason that rates are going up. If rates are going up because we have a strong economy, then and a strong dollar, that's a good thing, right? But if we have a weak dollar and rates are going up, that's not a good thing. That's implying inflation, which I don't think inflation is even on the table anymore, frankly.
Really?
I think inflation is going the other way. I think we're heading towards deflation. I think we are going to
Now,
be in a
now,
deflationary economy next year.
so just so because I want to poke at that, I've talked about this a bunch. And is that predominantly because of demand destruction, or is it efficiencies, or recession, or what's the thing leading you to call deflation next year?
The biggest part is efficiency and productivity.
Oh, okay, you're on that side.
I
All
think
right.
I think AI is going to have a big impact on productivity. Just like so, if you take it back to the 50s when we had a similar situation,
Sure.
what saved us was the baby boom
Of course.
generation,
Hmm.
right? So lots of people entering the workforce. We're not necessarily going to have that this time, but we will have improved productivity through AI and automation. Now that could take time to play out. So we're going to have a period before that actually happens that we may have some rough spots.
So do you still see a recession this year?
Not right now. I don't.
Okay. All right.
I mean, I don't see any signs of a recession at this point. They certainly could pop up at any time, but I thought by now we would be seeing recessionary signs. We're in the second month of the second quarter.
Yeah, that's true.
And last year I said around this time, second quarter is when we're probably going to see recession, but we're not really seeing anything that are related to recession. So we may not get a recession.
Okay. All right. All right. And then what? So again, you're talking efficiencies, productivity. So you're probably on the side that you think. I heard somewhere that we're aiming for 3% GDP growth. Very quickly
We
here. Is that something you see as possible?
Yeah, I think actually the GDP is going to be lower than that. I think we're going to have slower GDP, at least for the next 12 months. So during this period while we're transitioning to better productivity.
So stagflation?
I don't think we're going to have inflation either. So it's not,
Wow.
it's, I don't know, what do you call that?
Just
When
slow
you, when
growth,
you have,
below
when you
below
have
trend.
slow GDP and deflation,
That would just
depression,
no depression. You would have negative GDP growth. Not at all.
right?
No. So I
So
mean, yeah.
slow
If you have
GDP,
one,
slow
yeah. Just
GDP and lower inflation.
well, we had that for a decade. For the longest time, inflation was below 1% and GDP growth was around 2. So real
Right.
growth was 1.
Yes,
That's an okay economy.
that's right. Yep.
Okay.
And so then that brings up the question is what will the Fed do in June?
Jeez, there's no chance they're cutting. Give me a break.
You
June?
don't think that you don't think they're going to cut in June?
No chance. They're not cutting in June or July. No way. No chance.
Even with the pressure from other countries cutting
No chance.
their
No chance.
rates?
Zero chance. Zero. No, especially
Okay.
June. I mean, the Fed is out talking right now. I've read, I don't know, 9 to 11 Fed speeches or summaries over the last 48 hours. And they're all talking about, I mean, one of them said, we'll look at rate cuts in the next 10 to 16 months. I think that was Goolsby. Um,
Right.
Others are talking, Bostic said, I see one rate cut, but it's not till Q4. Yeah, there's no, they would be throwing softballs if there was a June cut coming.
Yeah. 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 I don't disagree. I think the jobs number, which comes out a week from next Friday,
Yeah.
yeah, almost 2 weeks from now, week from this Friday, the jobs number. I don't think it's going to be that bad.
I don't
I
think
mean,
so either.
it may tick up slightly, or it may just be flat, but I don't think it's going to be accelerating.
No, I mean, the June meeting's like 3 weeks away or 2.5 weeks away. There's just not enough data between now and then.
June 18th is the June meeting.
Yeah, so call it 3 weeks. Yeah. Okay. All right. Well, let's look at some
But
stuff. I want to
but
see what's going on.
before the June meeting, we've got another jobs number and we've got another CPI number coming before the
Yeah.
June meeting.
Yeah, and the CPI number will be interesting because this is the first of the 3 months where the base effect is. I mean,
Right.
again, I'm of the belief that inflation's going to go up this month just because of math.
Yeah, it could. It very well could. The next 2 months, 2 to 3 months, it could actually tick up or be flat, tick up slightly.
Yeah,
Yeah, it
Fed's not
absolutely could.
the Fed's not cutting if it goes
No,
up
but
1/10. There's no
right.
cut coming.
No.
Okay.
But then after that, it's going to start dropping like a rock again.
No, I agree. Yeah. Yeah. After 3 months,
So
it gets better after 3 months.
so
Okay.
by the end of the year, I think deflation is going to be the topic of
And just so
conversation.
we're clear, when you say deflation, that is a negative number. You're not talking disinflation. You're talking
That is
deflation.
a negative CPI.
Wow.
At least
Deflation coming.
at least a negative monthly CPI. It doesn't necessarily mean that year over year is negative.
Okay,
But
so we've had what in the last 18 months? I think we've had one negative
yeah,
month-on-month number. I think negative point
right.
one. I think.
Yeah,
Okay, so you're thinking by the end of the year we have and I think that's possible. There was a couple of monster numbers
right.
later in the year, so that's
Yeah,
possible. I'll give you that.
and negative CPI is not a bad thing.
No,
Deflation is not a bad thing as long as it's temporary.
correct.
The thing that makes it scary is that it starts to feed on itself, where consumers, which we'll look at that in a minute, but consumers will just stop buying. They'll say,
Yeah,
"Well,
they're waiting for a
I'm not
sale.
gonna,
Also,
I'm not gonna, I'll buy it next month. It'll be cheaper." And
yeah, well,
then when it is cheaper, they'll say the same thing. I'll just wait one more month. It'll be even cheaper.
And the feedback loop is much worse than that because when consumers behave that way, companies then have to make, cut heads and overhead,
Right.
and that's where the deflationary spiral gets
Right.
nasty.
And that's where we get into recession. And if it continues, depression eventually.
No, yeah, I mean absolutely.
It's,
That deflation.
that's exactly how it starts. But a temporary deflationary cycle
Yeah,
would actually be a good thing because
absolutely.
during the 4 years from the pandemic, there's been so much money supply added into the economy that inflation went up dramatically, much more than it has in the last 35 years,
Agreed.
almost by double just in 4 years.
Yeah.
And
No, I agree with you.
when I say it went up, I mean the rate of change year over year went up during those 4 years. But once it's up there, it stays up there unless we have deflation.
Correct.
So just having disinflation with the rate coming from 3 to 2.5 or 2, that
Does
just
help.
means the rate is not going up as fast, but it's still going up.
Correct.
So
That's what it means.
a short period of deflation would actually be a good thing, and what actually would, in truth, bring that number down.
A 3, 6, 9 month deflationary uh, part of this would be kind of cleansing, frankly.
Right? Yeah, it would. And I think everything right now is set up for cleansing across the board. I think there's a reset going on in
Yeah,
the economy, in the
I
global
agree.
economy, in fact.
I don't disagree with that. I think when you step back and look at 30,000 feet in a year, that's we're cleansing the system. We had a lot of fake stuff the last 4 years. We had a lot of bad deals done that didn't make sense, but they made sense
Right,
because of free money. Uh,
right.
we had a lot of real estate transactions get done because of low interest rates and tax breaks and all this other nonsense. They were just bad deals, and that stuff's got to get cleaned up. So I agree.
Hey, by the way, I watched a webinar by John Carter last week, and I actually put a link to it in my newsletter this week. And he brought up the 18 and a half year real estate cycle again. And he said that we're at the downward slope of that cycle right now.
Okay.
Meaning, and he talks about land, not necessarily houses, but the price of land is coming down. And he actually said he's telling his kids if they want to buy a house, don't buy it until 2030. Go rent somewhere
Okay.
for now, and 2030 the prices are going to be much lower.
Okay. Sure. Works
Be
for me.
interesting. Yeah.
Yeah.
Well,
Hey, I like guys who make calls. Put your name on the line. I like it. I'll take that
yeah.
bet.
Yeah. We'll see. We'll see what happens.
There you go. Well, let's look at some charts, man. That's why you're here. What's going on?
All right. Yeah. Well, we just covered a lot of territory, so
We did.
now we need to look at the charts that back all that up.
There you go.
For those interested, breakpointtrading.net is the website, and if you come to this page, you'll see the YouTube channel right there, the
Look
upper
at
right.
you, 1,280 subs, Rockstar.
Yeah, it's kind of slowed down lately, so I got to change things up. I'm starting to do a midday update.
Ah,
Just started that last week, so sometime I'm going to try right before noon, somewhere around there.
noon
It's
Eastern.
going to be very quick, like 5 minutes. I'll just look at the status of the S&P, and I'll look at the daily scan, what stocks my scan has produced that
I
morning,
like it. Okay.
and that'll be it. So far, the ones that I put out there, people seem to enjoy it. I think I'm learning on YouTube. People sometimes have a short attention span, so
True.
shorter can be better.
Can be.
All right, so let's say, where do we start here?
I'll go to Bitcoin
Let's
first. Why not?
Bitcoin. Okay, yeah, we'll look at Bitcoin. Bitcoin pulled back, had a nice run, pull back, and then it's resuming its run, basically heading back
Yeah,
up again.
because I think last week or it might have been the week before, you were telling us that 106 was that level it had to get through, and then if it got through, it
Yep,
could be headed
106
to
was
new
the key
lows.
level. It did. It blew through 106, and usually whenever it blows through a resistance, it comes back and tests that level.
Which
So it
looks like
pulled
it did.
back and tested the level, and now it's taking off again. So based on all this, the target right now for Bitcoin is probably 134.
Oh wow. Okay.
Not to say it's going to go straight there, just
Right.
over time, probably will go there. It has a golden cross right now. It's the only one of all of the ones that had a death cross. Death cross is when the 50-day crosses the 200-day.
Mm-hmm.
So Bitcoin had it back here, and then it had a golden cross right here. I did a technical Tuesday on the death cross. For those that are interested, I've got a playlist, and I did a whole session on the death cross and I went back and looked at different indexes over time, every time they had a death cross. And usually what happens is as soon as that death cross happens, they rally.
Hmm.
You know, the news, the press wants you to think that it's a terrible thing, that everything is going to crash, everything's going down because there's a death cross. It sounds really bad.
Yeah. But
But in reality,
it's a bottoming signal.
it usually marks the bottom, right?
That's funny. Okay.
So now we're heading back up again.
Okay.
So that's Bitcoin. Bitcoin looks pretty good. Now, interestingly, let's look at, this is one that I think everyone should be watching to see what happens. MicroStrategy went the opposite direction. This is Michael Saylor.
Yeah. He's basically turned MicroStrategies into a Bitcoin bank or whatever they call them.
Yeah, exactly. It's very high risk, could have a very high payoff if it works. But if it doesn't, I mean, what do you make of this? Bitcoin was going up. In fact, let me put Bitcoin right behind it. We can see what they look like together, because Bitcoin went up the last couple of days, but this one actually went the opposite direction. And put it behind price, and let's make it pink. So, oops, I want that to be pink. Bitcoin color, pink. All right. So there's Bitcoin. You can see MicroStrategy roughly follows along.
Yeah, roughly. Yeah.
Right. Until recently. Now Bitcoin came down, and now it's starting to go back up again. Mm-hmm. But it looks to me like MicroStrategy is coming down even faster, even more than Bitcoin.
Interesting. Okay.
So at some point, all of that zero interest loans that he's put out there to buy Bitcoin are going to come due. And I think the date is like 2027.
Okay.
And if all of his investors, the people that are invested in this particular stock, MicroStrategy, MSTR, change the name to Strategy, but the stock is still MicroStrategy. In 27, if they're not convinced that he's right about this whole thing, then this whole thing could just collapse. And it may have further impact across other asset classes.
Well, he's certainly the largest, if not, he's certainly in the top. I have no idea who the largest holder.
Yeah, he is the largest. He is the largest holder of Bitcoin.
Got to think so.
Yeah.
Okay.
So interesting to watch that. Okay. All right, let's look at the U.S. dollar.
Yeah, that'd be good.
Since we talked about that. And let's see what would be a good one. Here's a 45-year chart of the U.S. dollar with GDP and inflation. The U.S. dollar's down here. So basically, it's starting everything from 1980. If everything started at the same point in 1980, this is what it looks like. So the dollar is still up above zero. You can see the 10-year is climbing, inflation's climbing. This is that period, that 4-year period right here when it exploded higher.
Yep.
This is why deflation would actually be good. It could bring this down a little bit, but inflation typically just keeps going up. There's very rarely does it go down. Doesn't have deflation. We had it back here in the 2008 period. Yep. Had a little bit in 2006, a little bit right here in 2014. This is COVID. Had some here in COVID. But after COVID, it just exploded higher. And GDP keeps going up. So I think I actually have a better one for the US dollar that shows it over actually this one has 30-year mortgages, which you might be interested in.
Yeah.
So this is one that one of my subscribers really finds it really interesting. This has the Fed rate is the green one. Back here, the 10-year yield is the pink one, 2-year is the gray, and the 30-year mortgage is the blue one. So you can see how all of these are kind of going sideways. The 2-year and the 30-year are actually going down. Mm-hmm. The 10-year is going up and down, but kind of going sideways. But look at the Fed rate and look at the similarity just before recessions.
Mm.
Going back to 1990.
Yep.
It rolls over and then accelerates to the downside, which means the Fed's cutting. It is rolling over. The Fed had been cutting, but they've kind of stopped now. So the jury's still out, but this is just historical view of what that looks like. And 30 years down here.
Got it.
So let's see. I want to look at the rotation chart because I want to talk about the consumer. Consumer makes up 70% of the economy. I know I have it in here somewhere. Trend analysis. Rotation ratios. So these are the rotation ratios, and this is kind of what I mentioned before. And before we started, I said I didn't really have a lot to talk about because the market is just kind of waiting, just sort of testing levels right now. It's not really making a decisive move one way or the other. It has been coming down. You can see it rolled over right here, but it's sitting right on an upward trend line. It's sitting right on both the 21 and the 200-day moving average, all of those. So it's sitting right at a very crucial point, decision point. But here's discretionary versus staples. It had been moving up ever since April, meaning discretionary outperforming staples. Right now, it's just basically just starting to cross the trend line. And if it crosses the pink line, that's the 50-day moving average. Actually, this 21-day moving average right here, if it crosses that. Same thing with technology versus the S&P. Starting to roll over, technology here. Growth versus value. That's an important one. Yeah. So growth had been outperforming value through this whole rally period. It's now pulling back a little bit, and then the Russell 2000 is clearly underperforming.
So do you
think these are all sitting right at points right now that imply that the consumer discretionary might be pulling back. If this continues to go this direction, then we'll know in the next couple of weeks. If it continues to go down, then it's implying that the consumer is pulling back on their spending.
Well, let me ask or challenge you on that, because I see these as kind of one of two answers. The other one, we could have rotation, which I think is what this chart is really telling us. But couldn't it also be, and maybe it is, maybe it isn't, just people selling high PE stocks and staying in cash? Wouldn't that cause this as well, or is that not the case?
Yeah, yes, it would. It would cause this as well. Or and this is actually a relationship between two things. So it's discretionary versus staples. So that what that implies is they're not necessarily staying in cash, but they're moving to staples.
But
all right,
I guess
so they're moving to defensive. They're moving out of aggressive areas, moving to defensive areas.
Okay, so it is that movement. It's going from A to B. It's not I'm selling A.
This particular chart is going from A to B. It's a relationship chart. So if it's going down, it means staples is outperforming discretionary.
Got it. Okay, that helps.
If it's going up, that means discretionary is outperforming staples. So that implies, I mean, it could be moving to cash, and it could be selling the discretionary stuff and not selling the staple stuff and moving the discretionary into cash.
So that would work. Okay. So not selling staples, but selling discretionary would cause this also. Got it.
Right.
That makes sense.
Yeah.
Okay.
Yeah. It just means the staples through this period is outperforming discretionary.
Because that's what I'm seeing in my casual reviews is it seems over the last couple of weeks, since the dollar was down, since gold was up, Bitcoin's up, we're kind of seeing people pull back from high, I don't know if they're called high beta or whatever, high PE stocks, but maybe that's not the case.
Yeah, I mean, you could just look at the Magnificent Seven right here. They actually have been doing fairly well, other than Apple and Eli Lilly. So Apple is got three bearish signals, but everything else is too bullish. And down here, Netflix, Costco, Palantir,
Yeah.
and Broadcom, they're bullish across the board.
Got it. Okay.
So, I mean, we can actually look at, I mean, those are the high PE stocks,
Well, I think Nvidia
basically.
reports next week.
NVIDIA reports on Wednesday after the close.
Right.
So they could move the market.
Oh,
NVIDIA could move the market,
no doubt.
right? But if we look at this on a weekly, look at a weekly chart, and you can see this is Google. Google pulled back here in February with the rest of the market.
Mm-hmm.
So it's trying to make a run higher. There's Amazon going higher. Apple's the one holdout that continues to go lower. And that could have been, Trump's tweet about putting tariffs on individual products. I don't even know how you do that. How would you do that?
I don't know.
Is it even legal? Can you put a tariff on a specific product saying if you don't make most of it in the US and you have to pay more, you have to pay the government? I don't think that's even legal.
No idea.
But who knows? Meta continuing to go higher. Microsoft, big, huge move higher. NVIDIA, right there, report next week. That's going to make a big difference in what happens with NVIDIA. Yeah. Tesla, keeps going up.
So it actually doesn't look like people are selling.
No, it doesn't.
Stocks.
There's Netflix.
Yeah, they're buying. Buy.
Costco, Palantir's at new highs.
Yeah. What do you think about Jamie Dimon? Didn't Jamie Dimon just come out last week and saying the average buyer of stocks is being, what did he say? Not conservative or too risky or whatever?
Too risky, yeah. As a matter of fact, let's see if I'm not sure if I put this excerpt, but there's one particular guy that I follow. Here's the Memorial Day cartoons. Freedom's never more than one generation away from extinction. But there's a person that I follow, and every week I put in some excerpts from his newsletter. And he mentioned something in here about, I'm not sure if I put that expert. Yeah, right here. Retail buyers go all in. We started the market update by analogy between COVID pandemic and this year's correction. It's worth remembering that there are many competing differences.
Got it.
Unstoppable bull market. And it says, it's a really good quote in here. Patient risk reward. That's not it. Well, maybe I didn't put it in here, but basically said that it looks like retail traders are buying risk on, they're buying hand over fist.
Yep.
And then it said, well, what that means is that the Wall Street are the ones that are selling.
Yeah. Okay.
So if retail is buying, then Wall Street's the ones that are selling. So basically dumb money versus smart money.
Yeah. Okay.
This is another interesting one. Buybacks remain a powerful market influence. It says we are not bearish on the market because of buybacks over the next month. Recent surge has been the largest since October of 22 market lows. Wow. However, those will begin to fade in the middle of June, which could weigh on the markets into Q2 earnings reports. So buybacks are going to fade away by the middle of June. So this whole rally right now, which has not gone back to the highs yet, and we could, if it rolls over, it's already started to roll over, but if it continues, then we will have a lower high, and then we may go back down again.
Okay.
So yes, you're absolutely right that retail looks like they are, just like Jamie Dimon said, they are risk off. Retail's buying everything. They think it's going back to all-time highs, but Wall Street's selling.
Yeah. Okay. Very, very cool.
So we have to be careful. There's a chart that I created. I'm going to look at liquidity, and then we'll look at the global international. So this one here I created. This is based on the John Carter webinar I watched about a month or so ago.
Yeah, I remember this one. Yep.
Yeah, and he said that the market the market will not crash if liquidity is still out there. Global liquidity is still positive, then the market's not going to crash.
Mm-hmm.
And he said that once liquidity begins to improve, it's about a 12-week lead time before the market starts to respond. Okay. And he mentioned a number of things that make up global liquidity, but the two main ones were the dollar and oil. And you can see oil, it makes, intuitively makes a lot of sense. Every country needs oil. If oil is getting cheaper, that means they have more money, right? US dollar, same thing. If countries denominated in reserve currency of the dollar, if they need to refinance their debt, and they do it with cheaper dollars, then they end up with more money.
Mm-hmm.
So there's more global liquidity. And then commodities, the 10-year yield, interest rates. And if all of these are going lower, then manufacturing usually starts to perk up and go higher.
Okay.
These two lines here are the 12-week lead time that he mentioned.
Oh, got it.
So you see where the dollar and oil started going down.
Mm-hmm.
And this is VTI is the total market, total US market. So this is where it started going down in February.
And then boom.
And then 12 weeks later, it started to go back up.
Got
These, the dollar and oil in particular, while oil picked up a little bit this week, the dollar actually started to go back down again. So if these continue going down, then global liquidity is just fine.
Okay.
And the market should be just fine as well. So, like I said, it's hard to really pick a direction right now.
Okay.
Because there's so many opposing factors going on. And then down here, the international, I created 3 charts. I might do some for the currencies too. So it'll be interesting to see Japan versus the dollar. But this is the German 10-year yield versus this is the US 10-year minus the German 10-year. So if it's going up, that means the US 10-year is more expensive than the German 10-year. All right, and this right here is a reason why the Fed might cut. Even though inflation and jobs might be under control, if this continues to go higher, then and all other countries too are cutting their rates, then that makes US products much more expensive.
For sure.
So this aside from the other 2 main reasons why the Fed cuts, this is another reason why they might cut. Just because we're basically in a race to the bottom even. And if other countries keep cutting their rates and the Fed doesn't, then this will continue to go higher. So this shows you the 10-year yield and the German 10-year down here.
Yep.
It's going higher. So the red line is the 50-day moving average. It's kind of a reference point. So you can see the German 10-year continues to go lower and ours is going higher, which is pushing the 20-year bond down and the dollar down as well. And John Carter made an interesting comment about the bond. He continues to say that rates will come down. He said the government will have no choice. They will have to lower rates for a variety of reasons. One is that difference with the foreign countries.
Well, so let me poke at that a little bit.
Here's,
So again,
here's the 10-year. This shows you the 10-year with the 20-year in the background, and you can see how opposite they are. So the 10-year just started coming down the last 2 days, and if that continues to drop, then it might be a very good time to get into the TLT, the 20-year.
Okay.
So go ahead.
Well, I was going to say is, when you say rates drop, I want to poke at that. Is John Carter talking about the 10-year rate, or is he talking about the Fed rate, or both?
The 10-year yield.
Yeah, because as we've seen in the last, I don't know what it was, been 9 months now, the Fed cut 100 basis points and the 10-year went up, I think 80
right.
basis.
Yeah.
So, and then we go back to Ray Dalio. Ray Dalio, actually, he's out a bunch right now, talking about Moody's not warning the U.S. folks about the real problem with the downgrade, and that is that the U.S. Treasury and the U.S. government's going to be forced to print, which is going to, be the real problem.
Right. Yeah, especially if fewer countries are buying our bonds,
Yeah, they're
that
just gonna
that
they're gonna
will that will
so
absolutely cause inflation. The only reason we've been able to print in the past, that we have
that's
a printing press basically,
yeah, we had
is
willing buyers.
because we're the reserve currency, and every other country in the world needs dollars in order to buy certain things. Oil, for instance,
Yep.
are transacted in dollars. But if that changes, like I said 2 or 3 years ago,
Yep.
if that begins to change and the reserve currency loses that status, then we won't be able to print money like we have in the past, because it will result in inflation, and
Yeah.
significant inflation.
No, there's no question. If the U.S. Treasury, the Fed, whoever it is, has to print money to become the buyer of last resort, the U.S. dollar is going down and inflation's going up. It's just how it's going.
Right. Yeah. And then this is a performance graph of foreign. These are ETFs, so you can actually buy these just like a stock. So emerging markets is EEM. Germany is EWG. So these are all ETFs for these different countries. And this vertical line here was where the market rolled over in February.
Okay.
And I probably should put another one here where it started to go higher in April, where the rally started. In fact, I'm going to do that right now. So here's where the rally started, right there. Now, what you'll notice before February, the US market, which is the pink line, was kind of moving along with Japan, but it's in the upper range
Mm-hmm.
above all the other countries,
Right.
until we started going down right here in February. And we're now at the bottom. Even with the rally, other countries rallied stronger than we did. So
Yeah, I'm
we
hearing.
fell
Yeah.
faster than other countries did, and other countries rallied more strongly than we did.
Yeah, I'm hearing more and more kind of big money guys saying the opportunities in rest of world, in the
Yeah,
near term.
right. And interestingly, Canada and Japan actually ticked up when all the rest of these went down,
Hmm.
and emerging markets as well. So if you just want to play emerging markets, you can do it with EEM.
Hmm. Okay.
Let's say I can look at it right here. So that's what it looks like on a daily chart. You can see right here
Wow.
from the bottom, screamed higher
Quite a
from the
move.
bottom. This is a weekly chart going back further, and then we can actually look at a monthly, which goes way back. So on a monthly chart, it actually did reach a higher point up here in 21 after COVID.
Mm-hmm.
It was way up here at 50. Right now it's at 46, but it looks to me like it's heading back up to that high and may actually take out that high and go higher than that.
Very, very cool.
So yeah, this probably would be a good play. Interestingly, it's underperforming the S&P.
Interesting. Well, there is undoubtedly a lot of stuff going on in the economy, lots of different signals, stuff that we're going to keep looking at week after week. Give us your closing thoughts and tell people again where they can find you.
Yeah, my closing thoughts. Actually, let me use this for my closing thoughts. This is what May. So we got only 4 days left in May. We're at Memorial Day right now. So you are here. This is from Stock Traders Almanac, going back basically roughly 20 years. So the last few days of May look pretty bullish, right? Typically
Yep.
moves higher.
Looks like.
And then they did a chart like this, but they ended it here. So I continued it and created my own chart with the
Hmm.
same indicators. So they said consolidation and post mid-month rally. So they stopped it at the 15th, and this continues up to the 23rd.
Hmm.
And you can see we had a little sideways movement and then came down significantly.
Got
So
it.
that's what it looks like right now. This is post-election year pattern going back to 1949, so back 75 years. And you can see up here, incumbent party loses is the red line. The green line is all Republican administrations. The pink line is fifth year of presidency, so that would qualify for Trump.
Hmm.
And then the blue one is the aggregate cycle up here.
Got it. Got it.
All right, and we are right here. You can see how far down we went. So remember, these lines are 75 years. This orange line is only 1 year.
Right.
So it by definition will create outliers, but eventually it will be incorporated into this average for these up here. But it's actually right back into the trend again right now. So that implies sort of a flat move across the summertime. This also ended on May 15th, so it's actually down a little bit lower from that right now. But this implies a flat move into the summertime and actually a down move until October, and then we head higher at the end of the year. So it doesn't mean it will happen, and we could get another outlier and go down or up. Either way, see, it went up over here. So this was an outlier to the upside.
Mm-hmm.
And then this is June. So this is what it looks like week after next. First week of June, first couple of weeks of June, actually, this is the first week, actually is pretty positive. And then it kind of goes sideways. You can see everything that's happening in this 1 week here, leading up to the Juneteenth holiday. We got CPI on the 11th, FOMC meeting on the 18th, and then options expiration, all in the same week.
Ooh, interesting.
And all of this is pretty much where historically the market starts to go down. And usually from this point on, the market, pretty much is fairly flat for most of the summer until we get to the fall. So it's really the last week of May and the first week of June is typically the bullish period, and then things start to roll over.
Very cool. Well, I know we're going to talk each and every week. You're going to do your daily casts, including midday updates, which I think is a lot of fun. What is your website and YouTube channel?
Breakpointtrading.net is the website. The YouTube, you just click on that little button right there. It'll take you to the YouTube channel, and you can get my newsletter. Yeah, this is free also. Just click on that button and you'll get the newsletter that I showed a little earlier.
Very cool.
And I have 2 videos in there. I got the John Carter video,
mm-hmm.
the replay for that, and I have one on options from
nice.
stock charts, which is really interesting for anybody that's interested in options.
Well, there you go, Dan. You do amazing work. You're such a go-giver. I'm glad you have your YouTube channel and doing daily stuff. Take care, bud. Thanks.
All right. Have a good weekend. Happy Memorial Day.
Yep.